Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard.
John, what's coming up on the show today?
Well, Jim, I'm going to be heading off to Toronto for the Metals Investor Forum and the PDAC conference in a few days. And before that, this week's show, I'm going to be talking about the strength in the gold market. That will be a part of my talk on Friday at the Metals Investor Forum. And in particular, this story of central bank buying of gold, where there's more to it than really meets the eyes. And we're going to talk about the bad thing that happened to Perpetua Gold Corp and by, in a sense, extension, Endurance Gold and its recent announcement about the antimony component of its gold project.
What do you make of the past week's GLD ETF's 1.4 million ounce holdings gain?
Jim, this was incredible because I've been talking and mumbling for the past year since gold bottomed in February of 2024 and then started this uptrend about the complete absence of any patterns of accumulation in the GLD ETF. Now, the GLD ETF. It has an arbitrage mechanism. It was invented in 2005 by the World Gold Council, which people like Pierre Lassonde contributed to its design. And what they were concerned about, they're a lobby group for the gold producers. And since 1980, after gold went from its $35 an ounce price, ended up settling around $400 plus or minus $50. The mining industry, dealing with this new higher real price that made a lot of formerly high-hanging fruit low-hanging, it has mined 3.7 billion ounces during that period, or 3.5 billion, on top of the 3.2 billion that had been accumulated before that, a good chunk of which came from the Witwatersrand Reef, from which about 2 billion ounces were mined during that period. And their goal was to make sure that there was a market beyond the bit of dental usage and jewelry in India for gold and make it an investor class easy for people to buy, because the traditional gold owner has either been small scale buying coins and little small wafers and stashing them somewhere, or large scale where you have the complications of needing to properly store your gold so it doesn't get stolen by somebody. So that's been largely a wealthy person's domain to be a serious investor in gold. So the GLD ETF was created as an alternative to these closed-end funds, which would be listed on the exchange, and they would own so and so many ounces. So the theoretical value of a share was the ounces divided by the number of shares. So that's what the price was supposed to be. But the problem they had with those closed-end funds is that when investors got excited, they would trade at a premium to the market. And when they didn't get excited, they would trade at a discount. And when nothing was happening, when things were going sideways, well, then they would also trade at a discount. So they weren't a very desirable investment vehicle for individuals who wanted liquidity. So the brilliant thing that they came up with was that they designated a dozen or so special parties, basically some sort of investment banker, who had the right to, if they sold a GLD short and then bought physical gold in the bullion market, they could close out that short by delivering the gold to the ETF, which in exchange would issue GLD shares, which would wipe out that position, and vice versa too. If the GLD was trading at a discount to its breakup value, they would buy that and at the same time short in the London physical market, which of course ordinary individuals cannot do, and then they would literally put those shares that they bought to the ETF and say, we want gold. So you had gold going in and out of this GLD ETF, and this was an arbitrage mechanism. So every time they did this, they were capturing the difference between these two markets. And that forced the price of the GLD to be very close to the underlying physical price, because of course the physical markets is like, today it's 6.7 billion ounces sitting out there, has a value of $20 trillion today. And the gold bugs, they hated it for some reason. I never quite understood, Gata, Bill Murphy, they all claimed that the gold wasn't there, but that was just foolish, because the purpose of this was to make sure that all this gold that these producers were producing every year. In fact, last year they managed to produce 101.6 million ounces from around the world, but they needed to make sure there was a home, a sticky investment home, and the GLD has done that. Now, the interesting thing that I liked about the GLD ETF was I started plotting it, and a graphic where I would plot each day's change, whether it was up or down. And when you look at that at different scales, you can see the periods where suddenly there's a whole string of up bars showing that the GLD was gaining ounces, and then down bars. So this was kind of an investor segment, and because it was a sort of more broader based audience, retail investors, sophisticated investors buying and selling the GLD, and of course their market was not totally in sync with the London bullion market. You could see when enthusiasm was running high and when it was low. Now, the peak for all of this was December 7th, 2012, when 43.5 million ounces was held by the GLD ETF. And gold at the time was $1,702. And this was just before it crashed in 2013. Now, today, the holdings are 29.2 million ounces. And as I mentioned, I've been sort of just mumbling over the past year as gold cranked up, making records continuously. The highest, I think, has been 29.37 during the past week. There was no activity in the GLD ETF. And then last Tuesday, all of a sudden, we had 6 days in a row of gains. Today was small. It was only 9,000 ounces that it gained. But today was a bad day for gold. It was down $50 at one point, even though in London it had closed up a couple bucks. In the New York market, it was showing down. It was also a bad day for all the cryptocurrencies. Bitcoin was down. Coinbase was down. Last week they had the joy of Coinbase was said, okay, yeah, SECs, we're not going to bother you anymore about being a proper exchange, and they're high-fiving each other about that. And then another thing called Bybit, which is a similar type of exchange, announces that North Korean hackers appear to have lifted $1.5 billion of crypto from their clients' wallets, and with all the other trashy stuff like the Trump meme coins and all the fake Trump meme coins that they shot into his wallet so that everybody could be fooled into buying this garbage. All of this has created a bit of a negative attitude towards the whole crypto sector, and what's interesting is that going along with this has been this strength in the gold. So 1.43 million ounces accumulated. It's about 1.13 million ounces up for the year. It's been down most of the year. So this is kind of a very interesting development. Now, to see that the retail is now finally buying it, that's kind of ironic that, they finally noticed that gold is up. It's at 2,900, knocking on the door of 3,000. You look at the charts of gold, and you look at the chart of Agnico Eagle, and you just say, wow, these things have gone exponential in the past 6-7 months. It's got to be over. It's got to go back to $2,000. And I think this is still hanging over this market. Disbelief that what's happening is a readjustment in the price of gold as opposed to just this rally that has happened, for whatever reason. Now, the official explanation that we keep hearing about is that it has been central bank buying. Now, I've put together charts of the central bank, official sector, history of gold, and it's quite fascinating. U.S. official gold peaked in 1940 when the United States owned 75.7% of all the above ground gold stock. And their total amount got even higher. They hit 664 million ounces in 1952. But they ended up having a problem, which was that they made the U.S. dollar convertible into an ounce of gold at $35. And from 1953 onwards, everybody in the rest of the world literally drained 373 million ounces from Fort Knox until 1972 when President Nixon closed the conversion window, basically leaving about 261 million ounces in the in U.S. holdings, half of them supposedly stored at Fort Knox, and there has been some concern over time, well, maybe that gold was also secretly unloaded by the United States to fund its ongoing deficit, but apparently the Treasury Secretary, Scott Bessent, paid a visit to Fort Knox, and from what he was shown, he says, well, yeah, no, the gold is still there. We don't need to worry about this gold that might no longer be there. So, but from the 90s onward, you couldn't swap your dollars for gold anymore, but all these central banks around the world did have gold holdings. And from the 90s until 2008, every quarter there was the decline, every year, a decline in the holdings of the central banks. Canada blew out their gold. They at least did it secretly, and they have nothing left now. The United Kingdom helped tank the price of gold by announcing these 50-ton periodic sales well in advance so that everybody could beat the price down and the Brits get as low as possible for their gold. And that ended up taking gold all the way down to 255.60. But since the crash, there was a lull in sort of 2008 to 2009. But since then, there have been net buying of official sector gold. And but when you look at what has happened, they bought about 175 million ounces added to what their stash is. But that's of 1.6 billion produced by the mining industry during this period. And I just got all the data and plotted it up. And since Russia's invasion of Ukraine, it's actually the official sector holdings have actually dropped, and not a big amount, a small amount. And the World Gold Council publishes this data. It gets it from the IMF, which gets it from the central bank. And you're sort of saying, I'm saying to myself, central bank buying does not explain gold's 26% gain last year and already a 13% gain on top of that this year. There must be something else going on. Well, clearly it isn't the retail investors out there. They kind of lost interest in gold when the Republican Party decided that Trump's policies, which are the complete opposite of anything that a Republican held as important. So all their usual talking points for being enthusiastic about gold have been flushed down the toilet. So they're somewhat ambivalent about it. And the doomsday preppers that are buying the gold bars when they do show up in Costco, clean them out right away, that's just a drop in the bucket. That doesn't explain how a market, an asset class that was worth $15 trillion at the start of 2024 is today worth $20 trillion. And the reason given for all this supposed central bank buying is that when Russia invaded Ukraine, the United States decided to retaliate by weaponizing the U.S. dollars and even seized some of the foreign reserves of Russia, and then used sanctions as a way to block Russia's ability to trade and execute in U.S. dollars. And a lot of countries, especially the members of the Global East, have all been thinking, well, if we get on the wrong side of America, that could happen to us too. So they have been likely thinking we need to reduce our exposure to U.S. dollars, and they don't really want each other's currencies. So gold is a natural bridge between completely relying on the world's sole reserve currency and going to some other currency like China and China's RMB. So the interesting thing that's that's happened here is what explains this. And lately, I've been reading about how how China's T-bill holdings have declined in the past few years. They have a lot less T-bills on their books, in the central bank books, than they did in 2009. And the reason they ended up there, because they run perennial trade surpluses against the United States. And so they would just ship those dollars back to the United States and buy T-bills, which presumably America would repay with something valuable down the road. But because they've run persistent trade surpluses, and last year they had a record trade surplus against the rest of the world, this has not been, it's not been very easy to reduce these holdings. So what people are suspecting is that China has started to hide its T-bills because it has this network of partly state-owned enterprises. It can squirrel away its T-bills inside this network so that they don't have to be reported as central bank holdings to the IMF, who then passes it on to the World Gold Council. So, and here's another thing about China. In 2000, when they started publishing their central bank reserves, they had 13 million ounces. Since then, they have produced 253 million ounces. Sometime in the 2000s, they actually became the biggest gold producer in the world and have been that for this period. But they've only added 48 million ounces to their reserves, so that they now have 73 million ounces of official sector. That puts them in 7th place behind Russia. The United States is there in first place with 260 million, and then Germany shows up with just over 100 million ounces in second place. But China is the official buyer of all Chinese gold production. So what did China do with those 253 million ounces? Well, 48 million obviously ended up in its central bank reserves. But did it sell the rest to its people and encourage them, don't rely on RMB savings deposits. You should buy gold because, we are a fiat currency nation, and we encourage you to buy gold. Or did they dump all that gold into the London bullion market and end up with more US dollars that they had to figure out what to do with? Well, I think that they have managed to keep all this gold and just hide it inside the country. And obviously China imports gold, so the people for their various jewelry needs and all that, they are buying gold. But this 253 million ounces have added to what they already had in 2000 when China super cycle started. They would have 278 million ounces controlled by the government, which is bigger than what the United States has. And if this buying in the past year and a half that has pushed gold up so strongly has also included more of China recycling its trade surpluses, there could be even more gold inside China's coffers. And that to me is the simplest explanation for how do you have gold go from sort of $2,000 level to $2,900 with only a few pauses along the way, with no real hype in America from the retail crowd. The gold bugs, they're all very, very quiet, like crickets sensing a fraud or something nearby. And I think this is not going to go away. Where we could see crypto meltdown because nobody needs that. Only Americans might want it. China's not going to want it. Nobody else in the rest of the world needs to own Bitcoin, which is basically a digital mirage denominated in US dollars. I mean, what's the point of owning that? That's for American suckers to own. So I think this gold uptrend, it's going to persist, but there is still this massive doubt out there that this incredible uptrend can be sustained, that it will retreat back below $2,000. And that has implications. If that were to happen, that has negative implications for the sector that I cover.
With gold at $2,900, why has Perpetua Gold Corp stock price dropped a third during the past week?
Well, people were sort of wondering about that. February 13th, they put out a financial update. They've got pretty much a permit to develop the stibnite gold antimony project in Idaho, and the market did not like what it saw, even though I had pretty much anticipated it. In previous Kaiser Watch episodes, I'd taken the cash flow or the ore schedule and all their assumptions in their 2020 feasibility study, poured it into a discounted cash flow model spreadsheet and run it at different prices. And I'd done a cost escalation where I said, okay, we've had this inflation. This was 5 years ago that they came up with these numbers. So I did as high as a 40% cost escalation. And yes, at the old base case price, this thing totally dies. But at current spot prices, it's in the money. Well, the numbers that they came out with, they had, and this is funny. The consensus numbers that they were stuck using were $2,100 gold, $10 antimony, and $27.50 silver. Now, $27.50 silver is pretty close to where it is now, so that's no big deal. But silver is a tiny, tiny part of the cash flow. Antimony, $10 is a reasonable price. Last year, there was 100,000 tons of it produced, and that was worth about $2.2 billion U.S. at $10 a pound. And the spot price outside China is now $22 a pound because China has imposed export controls. So in China, you can still buy it for $10 a pound, but outside of China, you need to pay double that. So what they did, what the base case prices resulted was an after-tax net present value of $1.39 billion at 5%, and the IRR came in at 15.4%. Now, $1.4 billion sounds okay, but the capex, which was $1.3 billion in 2020, it shot to $2.2 billion today, which is even more than I had escalated it. But the OPEX, and they kind of hid how they did the OPEX. They gave us cost per gold net of byproducts, and I had to do some calculations to unpack that, and what was sort of like a $25 a ton OPEX cost. It increased about 30% to about $33, $34. So that was reasonable. That was within line of what I expected. But when they used spot prices, which were $2,900 gold, $21 a pound antimony, and $31.50 silver, the NPV jumped to $3.65 billion at 5%, and the RRR was 27.1%. Now, going by the rule that the NPV should be bigger than the capex, that clearly passes, and 15% is sort of the minimum IRR you want to see for a project like this with a 15-year mine life. So 27.1% is good for that. But at the base case prices, it was not good because the $1.4 billion versus $2.2 billion capex, that's not really going to be built. So the market said, okay, at spot prices, and I run it using the existing ore schedule assumptions and just change the prices, and at $2,900, the capex under my model, it's $2 billion at 10% and $3 billion at 5%. So it's close enough to what they were coming up with, and in per share terms, about 69 million, almost 70 million shares fully diluted. The price range between the 10% and the 5% discount rate is sort of $41 to $61, and yet the market knocked it back from $18 to below $12 today, and the only explanation I can have, especially given the importance of the antimony for the United States, is that the market thinks gold is going to tank to the base case price of $2,100. And in that case, this project is dead in the water. And in an interesting tidbit for everybody, when I visited the Stibnite project back in 2018, I think it was 2018, 2019, did the tour of the project there in Idaho. There was discussion about the antimony, and I've always been a big fan of the antimony. That was the reason this place was mined back in the war effort during World War II, and why it was a mess in the first place, because they needed the antimony, and then the gold mine's supposed to be a cleanup operation. But while they were drilling, they had found a lens of antimony outside the pit walls. In the pit, it's like 0.06%. It's quite low grade, and one of the pits doesn't even have a meaningful antimony grade. But they saw that there was this sizable zone whose total in situ antimony reserve is bigger than the total global 106 million ounces that they will believe that they'll be able to recover from operating the Stibnite gold antimony mine. And so they worked into the permitting plan a special adit to be done, exploration adit to be done down the side. And somehow the U.S. Forest Service approved this. So what they now have is an emergency valve for if it suddenly became really critical to get a lot of antimony quickly. And again, what they would hope to recover from mining the open pit stuff with the low grade, it would be only a third of America's antimony needs. So this project has the secret back door to a very high grade antimony lens with more antimony in place and at high grade, a relatively small volume that could be emergency accessed and mined to serve whatever critical needs there are. So this project needs to go ahead. It'll clean up the mess from both the former gold mining and antimony mining. It will produce, awful lot of gold. And the question is, though, it's all about economics. Are you going to develop this $2.2 billion capex project if the NPV is $1.4 billion at 5%? No, you're not going to do that. So the market's still in this strange mode of not taking $2,900 gold seriously. They think that gold has to go down because Donald Trump is such a genius. He is doing such wonders to make America great again. Nobody will ever need to own an ounce of gold ever as a safe haven against everything, because Donald Trump is a genius, and along with Emperor Musk, is going to make America great again, and gold is going to tank. Well, I think the rest of the world kind of disagrees with that. I think gold will make it through 3,000 before the end of this year, and who knows where it will stabilize at.
Is antimony a potentially important byproduct for the Reliance Gold project of Endurance Gold Corp?
Endurance Gold Corp's Reliance projects, it's in southwestern British Columbia, not that far from the former 4 million ounce high-grade Braylorn mine. It's an epizonal orogenic system, and it's pretty much high up in the system. Braylorn itself, the veins were deeper, maybe 1,000 meters below the original surface. At the top part, you'll find mercury, and they don't have really much mercury at the Royal Treasure Shear structure, where they have chased this high-grade zone for about 1,500 meters. But farther to the north, there is evidence of mercury. What they have here is antimony and arsenic. Now, arsenic's a natural part of any orogenic gold system. You're always going to have arsenopyrite in the along with the gold, and they've even used the arsenic in the furred spruce needles as a pathfinder tool to figure out where there is potential gold in the ground that's also associated with the arsenic. And one of the things that they have been worried about, and this was interesting, I'm not sure where they've published it yet, but there's always a concern that there's too much arsenic in a project, and that whatever concentrates you produce, and they'll have to produce a concentrate from this. If the gold to arsenic ratio is too low, nobody's going to take it because they don't want to deal with the arsenic. But apparently the ratio is within lines that the smelters and that will take the con. It's just like any other orogenic gold system with an arsenic component. But the antimony, and at least in the higher up, we don't know what happens deeper when they go beyond the sort of 300-400 meter that they've so far tested in terms of vertical depth. We're hoping that when they go deeper, they're going to get into wider veins, higher grade, such as exists at Braylorne, which is kind of the way these things behave. But in the upper part, there is a close relationship between gold and antimony. And right now, a lot of the gold projects in the world, they do have antimony as a credit in there, and companies have been promoting, we're an antimony play. Now, antimony's gone from whatever, $5 to $20 a pound. It's a critical mineral, and it's going to, make our story big. Don't just buy any gold stock. Buy one that's got an antimony credit. And I've been talking about this with regard to Endurance and say, well, this stuff's naturally here. And the company finally went and said, okay, let's look at this antimony component. And they got all the assays together and composited them. And they published yesterday a list of what the antimony grades is in conjunction with the various gold grades. And they've got one crazy zone where it's up to 19% antimony, but most of it's sort of in that 0.2 to 1% range. Now, to put this into context, the stibnite project has an average grade of about 0.06.07. When I talked to Robert Boyd, the number that they feel would average out is 0.2%, which is 5-6 times better than what they have at 10 times better than what they have at stibnite. And at 0.2%, assuming 100% recovery, at $20 a pound, that's like $90 rock. And if they're ever going to open pit the upper part, the deeper stuff's going to have to be underground mined. The antimony, it'll likely only exist in the upper part of the system. It is conceivable to recover it as a meaningful byproduct. So they're doing they're looking now at what kind of flow sheet would be needed to strip off the antimony concentrate from the gold concentrate and make sure that we have a payable product. It's a long shot at the moment. We're still talking about a high grade gold system that we want to be $200-300 a ton rock value that can be mined underground. That's still the primary story. But the antimony kicker that they're now focusing on, it gives investors an extra reason to play a bet on this project. And it's a KRO favorite. It's still stuck in this 13-14 cent range. They're not going to finance here. They still have $4 million working capital. They hope to resume in May. In March, they will tell us more about exactly what they plan to do. Last year was an important year for them because they got a full season of drilling, unlike 2023 when fires chased them out of there. So they established new depth, new continuity. They can go deeper. They can stitch together certain gaps and show that there's meaningful zones here. They have enough to put together a resource estimate for say, an open pitable resource. They've got enough surface drilling, near surface drilling to do that. They're not sure that they want to do that because there's this tendency in the industry that, you put out a resource estimate, this is all you're ever going to have. Start doing your PEA, and if it's less than 1 million ounces, well, that's a pretty boring project, so we're not going to be interested. So what they're really hoping for is that the market starts to believe that $2,900 gold is the new reality. That's not going back to 2,100. And it's the same sort of problem that Perpetua Gold Corp has, except at a much bigger scale, because they now have their permit and they're ready to move this thing forward. And there's a critical need for the antimony, the byproduct from that project. In the case of Endurance Gold, it's never going to be a giant big open pit mine running at 20,000 tons per day. It'll be a smaller scale thing, but the project also has the potential to develop stumble across high-grade antimony lenses, such as this one 19% that's 4 kilometers to the northeast of where they are drilling off the Treasure Royal shear structure. So they may just in exploring the property, come up with high-grade lenses, which could become important down the road if the conflict between China and the global West doesn't settle down and everybody get back to trading metals back and forth the way they have been doing for the past 20 years.
John, thank you so much for the update.
You're welcome, Jim.
I'm Jim Goddard. We've been speaking with John Kaiser.
Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.